Edutrainment Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your Edutrainer, national insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant, your Edutrainer and coach for our Edutrainment workshops and our entry-level introduction into life insurance. And all this week, we're doing our introduction into participating whole life. Again, we do have non-par whole life, but basically what we're talking about is participating because that's the bulk of what's out there right now in whole life area, and I want to stick to that today. But today, before we get going too much farther, I want to talk to you and remind you that we're brought to you by Lincoln Benefit Life and Allstate Company, and a lot of their software, everything that we're teaching, you need to go back to day one and catch up on it. But if you want to catch up, you're going to need their software because we believe it's a really good tutorial illustration system, and it'll really help your learning experience. So go out to their site, www.lblsales.com/ETW. lblsales.com/ETW. As soon as you come to their page, go ahead and run installer, download it, and you'll be able to go page by page. And again, we recommend if you're coming in, we're at the very tail end of all our 65 workshops at the end of this week. You need to go back at the very, very beginning and lay the foundation and the cornerstone of our thinking so that you can have an appreciation of some of the things we're talking about today. Also, with Lincoln Benefit and Allstate, they have an excellent menu of first contact pieces that are excellent for prospecting and I just think great for marketing. You can see the URL at the bottom of the screen, or the search engine optimization doc that's attached to this video has the address. You can just copy, paste, and put it in your browser. It's too long to tell you what it is now. But when you come to this page, you'll see this one of my faves, Facts of Your Life. It's a great data collection piece by Allstate. They've really went out of their way to really use a great harvesting tool for client assets and ideas and beneficiaries and actually things I never even thought about. It comes in a hardback version or attachable email. You can have it absolutely free. You come out there and go ahead and download it. It's just great. And also out there is their prospecting letters and postcards. If you say, Steve, I just don't know how to really make first contact with my client on life insurance, they've already done that through prospecting letters and postcards. Just a heads up, even though it's been compliant approved by Allstate, if you're a registered rep and you want to use any of these pieces, you're going to have to get approval from your compliance department. And if you're with an insurance agency that has compliance protocols similar, you're going to have to get approval before you use it. And also remember, all our shows, if you say, I can't remember where I saw your show, Steve, because a lot of this is on YouTube and Vimeo, and sometimes people forget where the address is. Remember, you can always go to our site, www.brokersalliance.com. As soon as you come to the homepage, you'll see our red on-demand video button. Just click on it, and there you'll see all the Edutrainment workshops, and including our 5-day internet show called The Business Insurance Zone, and my weekend show called Welcome to the Weekend with Steve Savant. Well, today we're talking about dividends, and we have to tell you a little bit about how this happens because, as you remember, dividends are not guaranteed. They're actually a return of unused premium, but we're going to get into that in a bit. Now remember, if you say, Steve, I don't even have the manual, the basic manual, we're giving away the basic life insurance manual and the vocabulary page absolutely free. Just write me, thebiz@brokersalliance.com, and I'll send it to you. So let's go ahead and look at this about dividends. How are they made? How are they constructed? Okay, let's go to the Mondo pad here, and we're going to look at a dividend formula. Now, we're using a carrier that uses a formula. Everybody's formula is going to be a little bit different, but I think this is a basic understanding of the actual experience that we use interest rates, what our portfolio is pulling in, our mortality charges, and our home office expenses. All those are going to combine for our actual experience to produce these dividends. And again, remember, as we say, dividends are not guaranteed. The definition is it's a return of unused premium. We did a good job. We didn't need it all. We're giving it back to the client. And that is free up to basis. But after basis, then it could be a taxable event depending upon how long you keep the contract in force and how you take money out. Keep in mind that some people's big gripe about whole life is they think dividend is a return of overcharged premium. So depending upon your definition, depending upon what side of the fence and school of thought you think from, that probably is the definition is going to vary. Return of unused premium, return of overcharged premium. Now look at, this is a great little graph, 3 factors that have an impact on a dividend. The interest rate, which you can see, this is the majority of where we're pulling it from, our bond portfolio, whatever our portfolio is, and it has other things besides bonds, mortgages, whatever. That portfolio, whatever interest we're gaining off that, whatever actual profit, that's a big bulk of our dividend. Part of this is also our mortality experience. If we had really good mortality experience, I can charge less, and that all equals a better dividend and expenses. Now remember, at the end, they don't have to declare the whole thing, and rarely do. The board of directors is going to go ahead to look at this dividend and say, after we've gotten our interest gains and we priced out our mortality, had a pretty good year, and expenses, we're going to have a dividend left over, a profitability. How much are we going to give back? And if they want to be competitive, they're going to have to give a good chunk back. And especially in this market where it's so competitive and low interest rates, this is probably true more than ever. Usually the largest factors in these, again, are going to be interest rates and expenses. And then I want to look at this basic idea. Again, we're looking at a specific carrier, but I like the graphics and it's easy to explain. When I'm looking at this, I'm looking at the things that do it. To provide long-term security for customers, you have to have a composite that's conservative in nature. So what we've looked at here is we've looked at what their composite is in their earning or general account portfolio. Notice here that the bonds make up 73.5%. Very conservative. Almost always these bonds are going to be in the high-end investment grade bonds. You're very rarely going to see non-investment grade bonds in portfolios. You'll see some, but very small numbers. You'll also see mortgages at about 11.4%. Now remember, after the mortgage debacle, this has shrunk some, but certain carriers have stayed in because they believe it'll turn around. So in this case, I might be using mortgages. I might even have a little bit of stocks, and I'm talking so small that I don't even know why it makes even the grid here, but as you can see, it's barely visible on the grid here. Real estate, policy loans. Now keep in mind that most agents, most producers have always told clients that they can gain access to policy loans, and when they gain access to those policy loans, they told them they never had to pay it back, that at death it would just come off as the death benefit, kind of an accelerated benefit, if you might say, via policy loans. But just keep in mind, the policy loans are an accounts receivable on top of the carrier's balance sheet, and when those policy loans are ranked on there, the odds are they're not going to get paid back until the death occurs, and usually the spread in the loans is not that great, so there's a little bit of illiquidity for that part of their portfolio to be invested in higher returns. So depending upon the policy charge and everything else, that's a pretty good issue. Then, of course, they're going to have short cash and short-term cash positions, and then others that could be a potpourri of all kinds of different ideas. Now, you'll notice that what happens is interest has the largest impact on a dividend payout. About 2/3 of the general account are invested in bonds. With low interest rate environment, new investments produce lower returns than those generated by maturing in the portfolio. i.e., or an example, maturing 10-year treasuries might have 5% rate and a new 10-year treasury might have 3%. I would use the word today, the word might is probably it is. Now when you look at that, that means that your older stuff is 5.6%, the replacing block is 3.0%. Some carriers always give the complete dividend to their entire existing block. That means that everybody, old customers and new customers, get the same dividend. I can only tell you politically, I think that's the way to go. I think that's consumer truth, and I like that. Some carriers, every time they set their new dividend rate, they start a new portfolio. That means the existing clients may not be getting what the new clients are getting. Now, of course, in this environment, probably the older clients are really glad they're not getting what the new clients are getting. But again, trying to keep track of your portfolio, everybody says, well, who's dividend one? And I said, I don't know. Some of these carriers may have 8,000, maybe up to 10,000 dividend history since they've been doing this. So it's very hard to track when you're doing it portfolio to portfolio. Here's a little dividend history here, again, using one carrier. You're looking at the dividend scale compared to the 10-year treasuries. The 10-year treasuries are mapped out here in red, and then the dividend scale is blue, and then the dividend scale is mapped out here in red. Notice that there has to have been some good mortality as well as some good management skills inside the administration expenses for them to supersede this. Now, in the old days, back in the 82, the actual interest rates, as you can remember, the interest rates are very high. So when I'm looking at something like this, I'm saying, wow, the interest rates are really high and the dividend payout. But notice there was a crossover right around 87 to 88. And that crossover period, dividends started to exceed the 10-year Treasury, and it has been doing that ever since. So if you're looking at how do they do that when they're all fishing out of the same pool? Well, part of this again is good mortality experience and good home office management for their expenses. I like this graph because it really shows long haul rates of return and why you can use whole life for a long term, almost like a bond alternative, if you would, since we're talking about it. And I like it because it's conservative. And you know what you're getting. The only difference, what we don't know we're getting is, will the dividend continue to outperform it? There's no guarantees on this. You have to look at the historicity of the company, and do you believe that they've been good enough in their history to try to do always what's good for the consumer? So you just have to kind of look at that as your idea. Now, again, when we talk about the formula, we're looking at our premium. Our premium, we take our premium in, and we add to it our investment return. Then we subtract the mortality charges, then we subtract the expenses of the home office, and any changes that's going to occur in reserves, because we have to park money in the reserves to protect the death benefit liability that we're actually holding in the side account in our reserves, sometimes our AVR, and then what's left over here is the amount available for dividends. Remember, it's not the dividend yet, it's just the amount available for dividends. So just as a repeat, we go ahead and take the premium income, whatever that premium is, we add to it whatever return in our investment portfolio, we subtract the mortality charges, subtract the home office expenses, subtract any of the changes in reserves because of that, and that's the money available for dividends. Again, I want to be able to make sure that we're always talking about it. And then in this illustration, it just shows the basic dividends every year, and in this case, they're using a paid up additions death benefit, and as you can see, in year one, there's crediting it at the end. So, and remember, that's another thing. I hate to keep bringing up these anomalies, but basically we have people that credit at the end, but maybe the second year they'll credit it at the beginning. There's a lot of games to be played. You have to find out what inside the illustration, what the disclosure or caveats are to figure out when they're crediting at it, and do they have any kind of maturity credits or maturity dividends, and what the terminal dividend is. If I walked out of this contract, what kind of bump up, what kind of more dividends would I get returned because the reserves got freed up. But what this does is it shows me my paid up addition death benefit. And I'm looking at my cash value. Here's the guarantees, but I'm looking at the non-guarantees because my paid up additions is helping me accelerate my death benefit and my actual cash values. Now, as a basic example again on dividends, I'm looking at basic issues. The dividend, here's a company, I'm looking at two carriers right now. I'm looking at their dividend at 5.5 and a dividend at 7. I'm looking at their premiums, which are very close, and I'm looking at their total cash value performance and their 20th year IRRs and their 20th year cash values. I just want to bring up a point here, again, because dividends aren't guaranteed, but when I'm looking at an illustration, I wonder, is that dividend that they're projecting, is that dividend based on their history, is it warranted to look at? Is it a real number? And by the way, just a little side note for especially if you're a whole life purveyor and you don't like indexing, a lot of indexes use 20 and 30-year lookbacks. If you used the actual dividends paid and looked back at the last 20-year tranche, you'd be surprised that whole life would probably take out the S&P overall over the last 20 years. Remember the comparison, if I used the 20-year look back of the last 20 years and I looked at whole life's actual dividend history, you'd be surprised. You're going to say, wow, Steve, I didn't even know that. That's why when you're comparing it to using those kind of numbers, if you could go back and say this is what it was, and some illustrations in whole life purveyors actually put this in here, I think that's kind of a good counterbalance because you want to be fair. If you're going to show the 20-year look back on an IUL, an Index Universal Life, then show me the actual dividend that was paid, and you'll be surprised how definitely competitive this is. Dividend options, well, we're going to talk about that. This is kind of the beginning of the basics. When I talk about dividends, I want to be able to go to a place where I say, I have this dividend now. It's been given to me. What should I use it for? How should I use it? How do I make it work for my policy? Is it for indemnification? Is it for income? Is it for transfer use for some kind of inheritance issue like legacy planning or grandchildren skipping generations or charitable giving. Any of those issues, I want to know how I'm going to use my dividends.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, and sponsored by Lincoln Benefit Life, an Allstate company.